Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today I'm joined by a special guest, Walt Postlewait. Walt is a longtime banking and credit risk leader with more than 20 years of experience in commercial lending and financial innovation. He's the co-founder of Portfolio Watch and chief credit officer at MStreetX, where he works at the intersection of banking, technology, and access to capital. Over his career, Walt has helped deploy more than $600 million in funding to support small businesses, real estate, and economic development, and he's deeply focused on how banking can evolve without losing the human element. Walt, welcome to the show.
Well, thank you, Marc. It's a pleasure to be here.
So you spent much of your career inside banks and lending organizations. When people hear the word banker, what do you think they misunderstand most about the role today?
Oh boy, I would say banker as an occupation has probably taken a few negative hits with over my career. We played a pretty big role. Not me, and I've been in the community bank space for a couple of decades. I did start with the National Bank. I started with Bank of America out of college, and that's what started my career. But when you look at the housing crisis and that collapse in 2008, that was definitely bank driven. It was about profit and how can we squeeze more money out of the system. I think people think of the large national banks just because everybody knows of Bank of America, Wells Fargo, JP Morgan Chase, too big to fail type of banks. Unfortunately, I think the public has this misconception because I am a huge supporter of the community banking industry and my brethren there. And what community bankers are very different than, the quote unquote big bankers. And community bankers really are the fabric supporting small businesses in smaller communities. And it doesn't necessarily have to be smaller communities because there are plenty of community banks in very dense urban areas as well. But it is a different type of a bank with different goals. And if you're a big giant bank and you're a global bank, it's a different drive versus a bank with a few billion in assets and 10 branches in a fairly closed geographic area.
For business owners or individuals who think they can do everything online now, because you see that a lot now with the advance of technologies, do I even need a banker? Do I need this? Do I need that? I can just do it all myself. Like you mentioned, especially those community bankers who, kind of help out those small business owners. Do they still really need a banker? And where does the banker come in and help?
Absolutely. A small business owner needs a banker. And frankly, through most of my business coaching and helping businesses, one of the first things I tell a business owner is if you do not have a relationship with a banker, that should be the top of your to-do list tomorrow. And often when a small business owner thinks of a banker, it's only about a loan, right? I have to go to a banker to get a loan. And that's part of the story, but that's by no means the whole story. As a business owner, you have to wear a lot of hats. And I've been in banking since 91, so I'm really aging myself, right? Successful business owners surround themselves with experts, people who know more than they do about things about running a business. And part of that is the financial side. And that's why a small business owner needs that relationship with the banker. So they have a resource. If they have a question about banking, about capital, about finance, they have somebody they can call up and bounce an idea around or a question and get an answer. And then when a business needs that infusion of capital and they want to take on some debt, they have somebody to call to discuss that with. And relationship is a phrase that's really thrown around willy-nilly these days. But a true relationship is somebody who knows you by name. You have time to visit with them. Small business owners invest so much into their business. Well, part of that is investing into establishing a relationship. Take time. Find out who is your local banker that you like. You may have to talk to a couple of them. I always say to businesses, go down, pick 3 of the community banks around you, walk in. What's the feel? How are you greeted? Talk with the branch manager, talk to a lender. Just let them know you're in business. You're trying to establish a better relationship, and just have that conversation. It kind of starts off with small talk. Ask questions about the services they provide. And frankly, once you kind of decide who you want to go with, call up that lender, call up that branch manager, ask them if you can bring them a cup of coffee and just talk. And you're not talking about a loan. You're not talking about your specific needs. Tell them more about your business. Why did you get into this business? How did you get into this business? What do you want to do with this business? How does your business support the community as a whole? These are the things that resonate with a banker. Most businesses will need capital at some point, and you need a champion within that financial institution who knows you and can articulate what you're going to do with the money, how you're going to make more money, so then you can repay that loan. And it's a foundation, but you do need to invest time there.
How does that business owner then kind of build that into their business? Because you talk to many business owners and they have one thing focused. How do I sell more, grow my business, do this, do that? You're suggesting, okay, go meet some banker. They don't even want to go to a bank to deposit a check. And it's kind of, okay, now there's technology advances, which are great, but it's losing a lot of times that human element of the relationship.
It is. So 2 parts there, because most business owners will tell you that they don't have time to start, that process. And I have seen far too many business owners spend too much time in their business and not on their business. And I know that's kind of a cliche and, hey, that could be a bumper sticker, but it's true. As a business owner, you're not just a worker. You need to carve out time to think strategically about your business, where you are today, where you want to be down the road, whether it's 3 months, 6 months, a year, and figure out what is the progression and those steps to get there. If you don't do that, and I've seen this, and frankly, the hamster wheel where that business owner gets on it and they're just running without taking time to understand where they're headed. Those are the business owners. You may be successful for a year or 2, but you will burn out. You may not fail and absolutely collapse, but you won't be able to then monetize as well all of that time and energy invested in your business. Because you do have to think about, okay, how long am I going to be in this business? When it's time for me to leave this business, how do I exit? How do I set up my business to have value? So all of this time, all of this energy, all of the sweat and tears I've put into this, how do I make it valuable for somebody else to come buy it from me so I have something to show for those efforts? You got to get off that hamster wheel to do that. And so part of the coaching that I do is taking time to work on the business. One of the things that it's not at the beginning, but one of the tools or the tasks that I ask a business owner to do, or I have in the past, once they start establishing these good habits, is to disappear from your business for 2 days. Don't brief your staff. You just pick a long weekend and you call in Thursday and say you're not going to be in the office for the next 2 days and I'm not reachable. And then see how the staff does. Again, this isn't for the business that's been around for 6 months. This is somebody who's actually worked on their business. They have contingency planning. They've got a good hierarchy of people who can step in. They've got people cross-trained. Mark, this is where business owners need to mentally see themselves progressing to. being a business owner is hard. I'm a small business owner. It is a challenge. It's incredibly rewarding, but you can't be so busy all of the time that you can't strategically think about your business. And then the second part is AI and technology. It's great. It can be a convenience, but it's not a relationship. We use the fair amount of AI, and our platform has AI components, but AI will never replace relationships. And so you may think you're saving time because you're taking pictures of checks on your phone and magically it's deposited in your account. But what happens when one of those checks bounce? What happens when you need some sort of service where you've got a problem with a check, or you need to wire monies, or you need some advice? AI can give you something general, but that will not be of the same quality as going down to your community bank where you're known and asking those questions.
A kind of a two-part question on community banks and competitiveness. I guess the first part is, what does it take, or how do they stay competitive in today's banking landscape? And then where does the community bank still have an edge compared to those like mega banks or those fully digital platforms? And I know we've talked a lot about the relationship, but kind of, do they have relationship? Will they build a relationship with you too, or is there still, the community bank still has an edge there?
Great question. I always kind of joke that banks on the commercial side, what they're selling, if we're going to talk about a commercial loan, it's the same, right? It's dollars. They're selling greenbacks to you, the business owner, to meet your capital needs. So the product from that tangible money side, that dollar is worth the same amount, whether it's from this community bank, that national bank, or that credit union. The truth of the matter is, odds are your community banker will maybe be a slightly higher interest rate. And I try to remind people that you should not always shop on price. We all know that you can go bottom basement and you kind of get what you pay for. And the reason why community banks may have a slightly higher interest rate is economies of scale. Their cost of money is probably a little bit higher because they're probably paying their deposits. They're a little bit more than the national banks because they're trying to bring in those deposits from national banks. Because you have to remember that in the banking industry, they are not lending their money. They're lending their depositors' money. So they have to entice people to bring money and deposit it with them to do that. So they usually will pay a little bit higher of an interest rate to the depositors, which means their bottom line cost of money is a little bit more. But they stay competitive because they know the community. Hopefully you have that relationship. Big banks, it is very black and white. The bigger the bank, the more black and white it gets. What is your historic cash flow? Does your historic cash flow support the amount of money in your repayment that you're asking for? In commercial lending, usually that target is for every dollar you owe in a loan payment, your business is producing $1.25. We call that a 1.25 debt service cover ratio. That's kind of the standard. Sometimes it'll be a 1.20. It might go up to a 1.35 depending on the industry. But bottom line, the bigger the bank, the more they're just going to look at your historic, because that's easy. If you have a business in the last 3 years, you've been producing, on average, this amount of cash flow, and it exceeds that 1.25 debt service cover ratio, we can give you the loan. The smaller the bank or the community bank will actually look and spend time to understand why you're borrowing that money. How does that generate more cash flow for your business? Because you need that additional cash flow to repay the debt. Most people don't go out and borrow money for the sake of borrowing money without the desire to increase cash flow. And all too often that we're talking about, the reputation of bankers before. A lot of people think that bankers don't want to make loans, and all they do is look in that rearview mirror. Well, can you afford this loan, right? And there's a lot of truth to that, and that's truer in the bigger in the national banks. Generally speaking, a business that's borrowing money so they can do something in their business to produce more cash flow needs that additional cash flow to meet these ratios for the loan repayment for credit approval. If all the banker does is look at what you've done previously and you can't get to that magic number, you don't get the loan. But if you can sit down and, hopefully you have a business plan, it doesn't have to be super fancy. I've seen 100-page business plans tell me nothing, and I've seen a 5-pager tell me everything I needed to know. So, it's quality over quantity. But you're able to explain to this banker, hopefully you have a relationship, what you're going to do with the money, how that's going to produce more revenue, and at the end of the day, more cash flow for your business. So they can then take that, like I said earlier, you need a champion within that institution. Then they can take this, they probably have a loan committee. A lot of bankers have signing authorities, so you take it to 1 or 2 people and maybe you can get signed off, or maybe it has to be presented to a loan committee of 5, 6 people. And at a community bank, those are local people. You may even know some of the people on that loan committee. At a national bank, people are looking at the numbers. You've got people with millions of dollars of signing authority. If you fit in this box, you can get approved, but unfortunately, Mark, most of us don't fit in just a standard box. But that's how a community bank stays competitive against the nationals. And don't get me wrong, there is a place for the big national banks. If you're doing a lot of interstate commerce, you can't really beat the national banks, because you can walk into a Chase Bank in Oregon, and you can walk into a Chase Bank in Florida, and you can move money. It's now the same bank. When I started banking, literally each state, even if like a Bank of America Oregon was a separate entity and had separate disconnected systems from Bank of America in California. In Washington, it wasn't even called Bank of America; it was called Seafirst. But through the changes in regulations, banks have now been able to cross state lines. And so if you're doing a lot of interstate commerce, then these big banks make sense. But for 80% of the small businesses out there, the community banks, where you can have that relationship, that is their competitive edge. Because as things don't never go as planned. There are always surprises. There are always headwinds. And I don't want this necessarily to be a huge commercial for community banks, but through 5 years of banking in both national banks, both in community banks and community development financial institutions, CDFIs, and I can tell you more about those, because those are a great bedrock for small businesses that nobody knows about, unfortunately. But there are options out there, but I really have seen the most success when businesses are well established with community banks over the national banks.
Are the approval requirements for a loan the same between community banks and the big mega banks, and then also between community banks themselves? Or is everyone using the same ratios, or is it different from one bank to another?
There's fine tuning. One bank might have a lot of money that they need to lend out. When they look at their books, they're really liquid, and so they've got a lot of deposits that they're paying money on, and they don't have a lot of loans out, so they might push a button or two, or pull a lever and start approving at a 1.20 debt service cover, or maybe a 1.15 if they've got a really strong guarantor. There's little nuances, but generally speaking, banks are all looking at a debt service cover ratio. They're looking at liquidity within a bank or within the business. They're looking at current ratios, the current assets versus the current liabilities, because that is an indication of resilience. How many surprises can you weather? The more local that the decisions are being made is where you have more of the nuance. Mrs. Smith, who owns a bakery and is needing a new, commercial mixer and a new convection oven because she has reached her capacity. She's saying no to more accounts, commercial accounts, supplying, fresh baked goods for the coffee houses and whatnot. If that bakery doesn't have the track record, as I was saying, where those payments can be made from historic cash flow, that local bank may say, okay, you're at a 1.1 historically, that's not strong enough, but we can see that, you've shown us, you've said no to 5 new accounts over the last month because your equipment, you don't have the capacity to produce enough to take on these 5 accounts. Well, if you had these 5 accounts, your cash flow is going to go up by this much. Now we can approve your loan, because they can see and they can have that conversation with you just because closer proximity and more interest, frankly, in improving and supporting the community, that they're going to look at that. I guess I'll beat up on Bank of America because I used to work for them. At a Bank of America, if you're not in that big urban center where decisions are being made, you might tell the branch manager at your local Bank of America what you're trying to do, and they might really like you. But frankly, the person who's making that decision may be 500 miles, 1,000 miles away from that community, and they've got 100 other loans that they're going to be looking at over a month's period of time. They don't have the time to understand why this bakery will have the ability to repay that debt. So it's easier for them to say no. And it doesn't necessarily always go that way, but there's more of a propensity for those very quick black and white decisions because they're further away from the community. But as far as the ratios and how different institutions look at them, there is some tweaking, there is some nuances, but I think you see that more with the community banks. And frankly, I've seen it where even in the same community, one bank, like I said, may have a lot more money that they want to get out, so they may lower the rates. So they, the bank down the street might be at prime plus 2, and you need to start pushing more money out. So maybe you start pricing at prime plus 1.5 for like a line of credit or something like that. So there's different ways to compete against your the community banks and against the national banks, and it's all tweaking that happens in real time.
We talked a little bit earlier about technology and AI. Do you see technology and AI improving the lending process going forward? I think one of the things was frustrating for some people is how painful applying for a loan can be. And that's whether it's on the personal side, the commercial side. You gotta, find all these documents, and then they start sifting through transactions and cash flow and this and answering questions. Does technology or what do you see, or what gives you some optimism about the future of lending?
I think technology is playing a huge role, and with the betterment of AI, I see the first deployment really being in and around fraud detection, which I think is good for everybody. It's good for the bankers. It's good for the business owners, us as individual consumers. Unfortunately, the bad guys have this technology as well, so it may get harder and harder to detect. But AI is very good at spotting pattern shifts and pattern issues. So with online banking, I am a huge fan. I've been talking about relationships and getting to the branch and doing that. We are established with community banks, but a lot of, I'd probably say 70% of what we do is online. we deposit checks, through the phone. We look at statements through the computer. So online does help that. Where on the lending side, AI has really, I think, helped to streamline. And there's a whole bunch of companies out there trying to improve the front end workflow for commercial lending, where it's more organized as far as uploading your financial statements, keeping the business owner aware of where they are in the process of that loan approval. These platforms tend to have kind of built-in financial spreading to and analyze the financials a little bit faster and better than a credit analyst. It helps the lender kind of direct them on how to put together that credit memo, because instead of just a Word doc or an Excel doc, it's now kind of may not be AI driven, but the template and all is a bit smarter and thoughtful going through that. So I think technology will improve the flow where I've not seen a whole lot of advancement, and frankly, that's why we created Portfolio Watch, is once a commercial loan is approved, it's funded, it's now on that lender's books, often it's kind of forgotten about. And unfortunately, life never goes as planned. So these banks have loans on the books. They're supposed to be monitoring, they're collecting quarterly financials, usually maybe annual financials. They should be doing annual reviews, but the same people, often, in regardless of the size of the bank, often the people who are whose main job is to find new loans and do new loans also has to manage that portfolio. And so we created a platform to monitor that portfolio, to assist in collecting the financial statements. It also produces reports, and most importantly, it's looking for that problem borrower, the borrower who's going to be struggling and won't be able to make a loan payment in the next few months, and alerting the lender before they miss payments to allow that lender to reach out to that borrower, to come alongside them and help fix whatever that problem is. And I really do believe, as our platform reduces actual credit loss to lenders, it will allow them the ability to say yes to borrowers that they would have previously said no to, because they have that additional tool to just kind of monitor that risk. Because at the end of the day, banks are a for-profit institution. They are generating profits for their shareholders. Most banks are publicly traded, so they have shareholders. It's outside of the family. And so we have to remember that banks are a business too. And so, like any business, if we can reduce the cost of bringing that customer on board, approving a loan, finding that opportunity, and we can reduce the expense by reducing losses, that then allows more profits to be made. And in my opinion, going back to this belief of community bankers wanting to help their community, if they can reduce the credit losses, that allows them to open up to some more of the marginal lending that a regulated bank normally couldn't do. And I had mentioned CDFIs a little bit earlier, Mark. And most business owners don't know what a CDFI is, and that stands for a Community Development Financial Institution. These are loan funds that are certified by U.S. Treasury. Most of them are nonprofit, and they're not a bank. They look like a bank, smell like a bank, act like a bank, but the money that they lend out is not depositors' monies, because they don't have depositors. It's their own money, which means they're not regulated. So they get really creative on finding ways to say yes when a traditional bank would say no, because the regulators would have a problem with it. And so I'm a huge fan of the CDFI industry. I spent 12 years working with them in C-suite space. They are there to help that business that gets told no at the community bank come alongside that business owner, get them that capital, grow that business, and hopefully between 3 to 5 years, then that bank can say yes to them. And so really the CDFI business model, unlike a bank that wants a business as a customer for life, CDFIs really are looking for that relationship to be 3 to 5 years, and then graduate them up into the traditional banking industries and institutions.
All right, well, that's all the questions I have for you today. I want to thank you for joining me on today's episode. It was really great hearing from you on this topic. Before we close, where can listeners go to learn more about you, Portfolio Watch, or get in touch with you directly?
Certainly. I'm in LinkedIn. Portfolio Watch is there. I'm there, Walt Postlewait. My email is wpostlewait@portfoliowatch.co. Please reach out. If you have questions or want to bounce something around, reach out. I love working with small businesses and trying to give business owners tools to make them more successful. I've spent the last 30 years doing that.
Great. We'll include all that information in the resources section of the show notes. Thanks again, Walt, and thank you to everyone who tuned in today. Don't forget to follow the Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.